This week, a memory chip company in South Korea had a bad Tuesday. And within hours, Bitcoin, an asset with no CEO, no factory, no earnings call, and no chips, dropped below $63,000. The Federal Reserve didn't meet this week. Nobody cut rates. Nobody hiked. Nobody at the Fed said a single word that moved a market. And Bitcoin still fell 50% from its all time high, $126,000 last October, 63,000 this week, while a chip stock in Seoul was doing the driving. Almost nobody stopped to ask what that means. It means the thing every Bitcoin holder has been trained to watch, the Fed, is the wrong instrument panel. Bitcoin's next crash is not coming from that building in Washington. It's coming from something with a margin desk, a street address, and a timer already running. And by the time I show you what it is, you'll understand why I'm not afraid of it, and why I'm actually planning around it. I follow this wiring every morning on a dashboard I built for exactly this. I'll show you the piece that matters most in a few minutes. But first, a piece of history almost everybody remembers wrong. Here's the version of history you've been sold. The Fed giveth, and the Fed taketh away. Watch the Fed, and you'll see the crash coming. Now watch what actually happened. Twice. March 2020. Bitcoin fell from roughly $7,900 to under $4,000, 52% in about 2 days. The fastest crash in its history. And what was the Fed doing that exact week? Cutting. Slashing rates to zero. The most aggressive easing campaign in its history was warming up while Bitcoin was cut in half. If the Fed controlled Bitcoin's crashes, that crash was impossible. So, what actually did it? Margin calls. A cascade of leveraged traders getting liquidated, each forced sale triggering the next one, on exchanges whose liquidation engines couldn't keep up. Here's the detail that tells you everything. The crash stopped when one of the biggest exchanges went offline. The selling didn't stop because the Fed spoke, it stopped because the machine doing the forced selling lost power. That is not monetary policy. That is a repo man having a busy night. Now 2022. Bitcoin 69,000 down to about 15 and a half, 77.5%. Yes, the Fed hiked all year, but look at where the actual craters are. May. That's not a Fed meeting, that's Luna. $40 billion evaporating. June. That's not a rate hike, that's Three Arrows Capital and Celsius. Leveraged funds and fake banks failing. November. The biggest crater of all. That's FTX, an $8 billion hole where customer money was supposed to be. Every single leg down has a name, an office, and a bankruptcy filing. Not one of them is the Federal Reserve. Four different businesses. One identical disease. Somebody stood between the saver and his coins, and that somebody had borrowed against them. Not one failure was caused by the coins. Everyone was caused by the man in the middle. The Fed was the costume. Leverage was the killer. Every time. The coroner's report never once said interest rates. It said margin call, margin call, margin call. Nobody gets to interview the liquidation engine, so the cameras film the podium, and the thing that actually pulls the trigger sits in a building with no press room at all. And I can hear the objection because it's fair. Those were crypto casinos blowing up. Cowboys. That world got burned down. Who's the leveraged cowboy this time? That's the part they're not telling you. This time the leverage isn't in the casino. It's on Wall Street's own books, and it's wired straight into the AI bubble. Between 2024 and today, 3 sets of wires got run between Bitcoin and the AI trade, installed in public with press releases. Almost nobody has stood back and looked at the breaker box they add up to. Wire number 1, the ETFs. When the spot Bitcoin ETFs launched, everyone on our side of the fence celebrated. Wall Street finally adopted Bitcoin. And it did. But adoption mechanically means this: Bitcoin became a ticker in the same model portfolios that hold the AI trade. The same advisor who put your neighbor into NVIDIA put him into a Bitcoin ETF in the same account under the same risk score. Think of it like plumbing two houses into one water main. Very convenient, right up until there's a pressure drop, because now there's no such thing as a leak that only floods one house. When the AI names get sold, the risk models don't ask what Bitcoin is. They ask what bucket it's in. Same bucket, sold. And the machinery makes it automatic. When ETF holders sell, the fund sheds actual coins, same day, at market. A retirement account in Ohio clicking Reduce Risk becomes real coins hitting the real market within hours. In the old world, a scared holder had to decide to sell his coins. In this world, a model rebalances a bucket, and the selling happens to him. We watched the preview already. This summer's outflow waves ran into the billions in a single month, and price followed them down like a dog on a leash. Adoption was real. So is the leash. Wire number 2, the treasury companies. A whole class of public companies spent this cycle borrowing money to buy Bitcoin and holding it on a leveraged balance sheet. The biggest one, Strategy, Michael Saylor's company, holds 842,138 Bitcoin. That is roughly 4% of every Bitcoin that will ever exist, sitting inside one leveraged public company. Their average purchase price is about $75,400 a coin. Check today's price. They are underwater on the average coin they own. Last quarter, they reported a net loss of $8.22 billion. A paper loss, let's be honest. The mark on coins they still hold. But here's the number that isn't paper. This year, for the first time, they've been selling over $300 million of Bitcoin so far. And they gave it the most Wall Street name imaginable, a monetization program. And the newest batch is the Tell. Last week of July, 1,638 coins, $105 million, sold at just under $64,000 a coin, against a cost of $75,400. They are selling below their own cost. When a company that spent 5 years telling you it would never sell starts selling at a loss and names the selling like it's a product launch, that's not conviction. That's a balance sheet negotiating with gravity. Remember the ARC, because the ARC is the warning. For years, the market paid a premium for this wrapper. The stock traded above the coins inside it. That premium was the fuel. Issue stock above the value of the coins. Buy more coins. Watch the stock rise. Repeat. A flywheel, as long as the premium holds. And now? As of January, about 37 of the 100 largest Bitcoin treasury companies traded below the value of the coins they hold. The market is valuing the company at less than its own Bitcoin, telling you the wrapper subtracts value, and the flywheel doesn't have a neutral gear. Below the line, it runs in reverse, and the cheapest way to create value is to sell the coins. Companies in that position don't get to be long-term thinkers. They get to meet debt payments. And there is exactly one asset on their balance sheet that can be sold at 3 in the morning on a Sunday to meet one. Wire number 3, the one almost nobody has connected, the miners. Bitcoin's industrial base, the data center companies that secure the network, spent the last 2 years converting themselves into AI companies. Core Scientific, Hut 8, TeraWulf, one after another, miners release their power contracts and their buildings to the AI build-out, because AI compute paid better than mining. So the companies keeping Bitcoin's lights on are now financed by AI credit, the same private credit machine of circular deals. One AI company lending to another so it can buy capacity from a third, now runs through Bitcoin's own infrastructure. A $4 billion financing in exactly this corner failed this summer. The cracks aren't theoretical, they've started. So look at the breaker box. Demand, the ETF bid, wired to the AI portfolio. Supply, the biggest single stack of coins on Earth, wired to leveraged balance sheets already underwater and already selling. The industrial base, wired to AI credit directly. 3 wires, 1 bubble. The Fed doesn't hold any of those wires. Wall Street holds all 3. And one more piece of physics decides how the current flows, and it's the cruelest one. In a credit fire, Bitcoin is the fire exit. Not because it's the weakest thing anyone owns, because it's the easiest thing to sell. Bitcoin has a live bid at 3 in the morning on Thanksgiving. A private credit stake can't be sold this month. A data center can't be sold this year. So when the margin call comes, the rule of every fire applies. You don't sell what you want to sell. You sell what has a bid. That's March 2020 in one line. The margin desks sold the one asset they could actually liquidate on a Thursday night. Being the most honest market on earth means you're the first thing thrown out the window when dishonest balance sheets burn. That's not a flaw in Bitcoin. That's a compliment with a body count. That $63,000 print this week, on a day the Fed said nothing, that was the wiring being tested. A little pressure on the AI trade in Sol, and the current came out the other end in Bitcoin, within hours. The test worked. The circuit is live. But before the full cascade, I need to deal with the chart half of you are already thinking about. I can hear the veterans now. Tim, we don't need the AI story. It's just the 4-year cycle. If you've been in Bitcoin longer than one cycle, you've seen this exact chart. April 2019, posted on TradingView, picked by their editors. Accumulation, parabola, bear, halving, repeat. It's the map. Half of Bitcoin YouTube navigates by it to this day. And let me be fair to the map. Its record is better than you'd guess. In 2019, in writing, it called the $3,100 bottom, 6,000 by Christmas 2019, 20,000 around Christmas 2020. 3 for 3, years in advance. If a stock picker did that, you'd give him a show. Then read the next line on the same chart. Its 2021 target, written right there in the annotation box, was an all-time high of $200,000. That never printed. Not in 2021, not ever. The real talk was 126,000, October 2025. The same map that nailed the bottom missed the top by nearly a factor of 2. And its own author labeled the next extension, the $1 million line, quote, just for a bit of fun. So is the cycle real or not? Here's the honest answer, and it's the most important 60 seconds in this video. The cycle has been very good at calling when Bitcoin gets fragile. It has never once called what pulls the trigger. Why would a rhythm like that exist? Partly the halving. New supply cut in half every 4 years on a schedule written into the protocol. Partly us. Enough people believe the map that they position for it, which makes it self-fulfilling on the calendar and useless on the cause. 1 million people can agree on when the season changes. Not one of them gets to choose the storm. Look at the actual tops. 2017, about 17 months after that year's halving. 2021, about 18 months after. October 2025, about 18 months after April 2024's. 3 cycles, same clock. The rhythm is real. I won't tell you it isn't. But the clock never names the killer. 2020, a virus and a margin cascade. 2022, Luna and FTX. The cycle chart drew a red box that said bear market goes here. And history filled the box in with whatever leverage happened to be lying around. The map tells you the season. It has never once predicted the weather. Which is exactly why this video exists. The season, by the old map, is here. We're 10 months past October top, 50% down, right where the red box starts. The only question that matters is the one the map can't answer. What's the leverage lying around this time? This time you don't have to guess. You just watch me trace the wires. It's the AI bubble. The cycle is the calendar. The AI margin call is the gun. Quick word on that framework. The halving clock, the drawdown history, the live Bitcoin price. I keep all of it on one screen. My macro command center dashboard. And that Bitcoin number I showed you earlier is live on it right now. Now let's talk about what this costs you. Because so far, this sounds like a story about Wall Street's problems. It isn't. It's a story about yours. If you're watching this channel, odds are you're not a leveraged trader. You might not own any Bitcoin at all. So why should a man with his savings in index funds and a paid-off house care where Bitcoin's next crash comes from? Because of what the wiring does to the word diversified. The entire promise of the portfolio you were sold, stocks for growth, bonds for safety, maybe now a little Bitcoin ETF because your advisor finally allowed it, is that these things don't all fail on the same day. That's the whole product. That's what diversification is. Now run the cascade. The AI bubble deflates. Not even crashes, just deflates, the way it wobbled this week. The index funds take it directly. The AI names are the index now. The risk models downgrade the whole risk asset bucket, and your Bitcoin ETF is in that bucket. So it gets sold by the same machine on the same afternoon. The treasury companies watch the price drop toward their covenants and become forced sellers, accelerating the very drop that forced them. The miner's AI side credit tightens at the same moment. Every wire carries the same current, the same direction, the same day. Your diversified portfolio turns out to be one trade wearing 5 costumes. The pressure lands on your statement from every direction at once. The AI names you own directly, the index they dominate, and the Bitcoin exposure that was supposed to be the uncorrelated part. The saver pays on every wire. He always does. The man who built the leverage gets a monetization program. You get a statement. Put real numbers on it. Take a man with 500,000 saved, 60% in stock index funds, a little Bitcoin ETF sleeve his advisor finally blessed, the rest in bonds and cash. The AI names sit at the top of every market cap weighted fund he owns. The biggest names are the fund. Run scenario 2 through that statement. The AI heavy index gives back 30%. That's $90,000 off his 300 in equities. Gone before he's finished his coffee. His $25,000 Bitcoin sleeve, the uncorrelated sleeve, gets sold by the same risk models on the same afternoon. Cut in half in a wrapper cascade. 12,500 more. Over $100,000. One man, 1 week, and not $1 of it because he was wrong about anything. He diversified exactly as he was told. The wiring undid it behind the wall. And the statement is how he finds out. And here's the quiet part. The people who wired it this way are not confused. They understand exactly what correlation under stress means. They just needed the yield, the fees, and the premium this quarter. The wiring pays them on the way up. It bills you on the way down. So that's the crash. Wall Street's leverage, AI's credit, one cascade, your statement. If the video ended here, it would be a fire report, a man describing your house burning and walking away. It doesn't end here. Because one thing in that entire cascade doesn't have a margin account. And it's the thing actually worth understanding. Go back through every wire we traced tonight and notice what each one actually is. The ETF. That's not Bitcoin. That's a wrapper, an issuer, a custodian, a risk model. The Treasury Company. That's not Bitcoin. That's a wrapper, debt, a board, dilution, and a margin desk standing between you and the coins. The miner with the AI pivot? That's not Bitcoin either. That's a business near Bitcoin, financed by credit, run by men. Every single thing in the cascade, every point of failure, every forced seller, Every 3 a.m. liquidation is a wrapper, and every wrapper has the same two features: an issuer who made it and a lever that can force it to sell. A margin account, a covenant, a redemption, a man. Now ask the question this channel asks about everything. What about the thing inside? 21 million coins. Fixed. Forever. No issuer to dilute it, no board to lever it, no margin desk to liquidate it, no man to call at 3 in the morning, because there is no man. No servers, only a protocol. When the Cascade comes, and the wiring says one is coming, every wrapper around Bitcoin can fail, and the arithmetic of Bitcoin itself does not move by one coin. The ledger doesn't know Sol had a bad Tuesday. The 21 million was the same number at $126,000. It's the same number at 63, and it will be the same number at whatever the margin calls print at the bottom. And the proof already ran live in every crash we've talked about tonight. In March 2020, while margin desks cut the price in half, the Bitcoin network kept producing a block roughly every 10 minutes, because as far as the protocol was concerned, nothing was happening. The night FTX died and a million people discovered their Bitcoin was a number in a bankrupt company's database, the ledger itself processed every transaction, on time, for everyone who held their own coins. No emergency meeting, no trading halt, no discount window. The protocol has never needed a rescue, because there is nothing inside it that can need one. No debt, no redemption, no counterparty. Every crisis you've watched was a crisis of the men standing around Bitcoin. The thing itself has never had a bad Tuesday. This is the distinction that separates everyone who survives what's coming from everyone who doesn't. The price of Bitcoin is currently a hostage of Wall Street's leverage. Bitcoin is not. The price is what the most desperate wrapper has to sell at today. The asset is the one thing on earth the desperation can't dilute, can't vote on, and can't print more of. They wrapped the incorruptible thing in corruptible packaging, and when the packaging fails, the whole world is going to watch the price of the contents crash and conclude the contents failed. That's the misread of the decade. The house's wiring caught fire. The gold in the safe didn't burn. It never does. The safe doesn't have a margin account. So let me put my own cards on the table, because this channel doesn't do prophecy. There are no certainties, only probabilities. Here's how I'm handicapping them. Scenario 1. The wiring holds. The AI credit machine keeps rolling its debts. The deflation stays orderly, and Bitcoin chops sideways in this range. In that world, nothing I said tonight gets tested this year. The fragility just sits in the walls, and the season stretches. That's a real possibility. Anyone who says otherwise is selling certainty they don't have. Scenario 2. A wire fails. A treasury company hits a covenant. A private credit AI deal breaks and takes a lender with it. One overloaded circuit and the cascade runs exactly like we traced. Risk bucket sold, wrappers forced, Bitcoin's price dragged down by machinery that has nothing to do with Bitcoin. How far? Nobody knows, but the history gives you the honest range. In 2018, the drawdown was 84%. In 2022, 77.5%. From this cycle's top of 126,000, we're at minus 49 today. A fall into the low 40,000s would be minus 68%, a milder bottom than either of the last two cycles. That's not a prediction. That's just what the same red box has measured, twice. And here's my personal answer, as a man, not as a forecast. If the wrappers ever fail hard enough to mark the one asset with no issuer down into the 40,000s, I intend to be standing there, calmly, on the other side of that trade. Not because a chart told me to, because I know the difference between the price of Bitcoin, and a forced seller's price is the one moment the two have nothing to do with each other. The man who understands that doesn't experience the next crash as the end of the story. He experiences it as the moment the door out of this system goes on sale. I'm not telling you to do that. I don't tell anyone to do anything with their money. You know that's not how this channel works. I'm handing you the wiring diagram, the history, and the arithmetic, and you'll walk through whatever door you walk through yourself. But decide now, calmly, what a forced seller's price would mean to you. Because deciding it mid-cascade, with the red screen screaming that Bitcoin failed, is how the last two cycles took the coins from the people who understood everything except their own nerves. 3 signals to watch so you're not guessing. Signal 1, the treasury companies. Watch whether the big one's selling accelerates. More monetization, more coins out the door in the filings, public documents, on a schedule, for free. Signal 2, the AI credit calendar. Every private credit financing in the AI build-out that fails or gets repriced is a wire heating up. A $4 billion one already broke this summer. And this one comes with dates. The lockup expirations on the biggest IPO in history run August, September, and December. The first of them, 911 million shares, unlocked this very week. Insiders freed to sell into a falling market. Those are the days the AI complex's need for cash gets measured out loud. Mark them. Signal 3, the simplest. Watch what moves Bitcoin. Count the days its big moves land on chip earnings and AI headlines instead of anything monetary. And when the crash comes, run the tests that started this video. Check what the Fed was doing that day. I'll bet you what I bet in March 2020. The answer will be nothing. One last piece of the map, because it turns a scary story into a complete one. Ask what happens after the wire fails. The AI credit machine seizes, the index funds bleed, and the retirement accounts of 100 million voters go red in an election-adjacent economy. What does Washington do? What it has done every single time. 2008, 2020, 2023. It rescues. And every rescue is paid for the only way a government this deep in debt can pay. It's printed. So the AI crash doesn't end the story this channel has been telling all year. It accelerates it. The crash forces the bailout. The bailout dilutes the dollar. The dilution strengthens the case for the one asset that cannot be diluted. The margin call that drags Bitcoin's price down is the opening act of the process that proves why Bitcoin exists. The wrappers fail, the printer answers, and 21 million stays 21 million through all of it. There are no certainties, only probabilities. But that sequence has run 3 times in 15 years, and the men running it have never once chosen the other option. If you want the same instrument panel I've been reading from tonight, the live Bitcoin price, the macro numbers that actually matter, all on one screen instead of 14 tabs, it's free at timtalksfinance.com/members. No credit card, 2 minutes. Take the money quiz while you're there and it'll show you, in dollars, what this system is quietly costing you every year. I built it so you don't have to figure this out alone. The Fed will meet again in September. Every camera in finance will point at that podium. And the thing that will actually move Bitcoin will be sitting in a margin account in a building the cameras never film, wired, wound, and waiting on a chip company's bad Tuesday. Watch the wires, not the podium. $63,000, and the Fed never said a word. Now you know why.